Hello and welcome to MoreTalk. It is Thursday at 2 p.m. here on the East Coast.
And it is 11 a.m. here on sunny San Diego on the West Coast.
Excellent. And I am excited about today's show. We have a lot of special guests planned, and hopefully they can join. Remember, this is a radio show, so we want you to come Thursdays, 2 p.m. Use hashtag MoreTalk, all one word. And you'll be able to find your way around LinkedIn to find us at 2 p.m. Eastern. And that's where we tape this show. So if you're listening, you can come back to the next show and raise your hand, and you can come up and listen. But today, we have three amazing guests that you'll be able to listen to. One is Greg Sher, who has his pulse on the industry, and what a week it was in the industry. So Greg Sher is, it's almost like our correspondent in the field, except he's more famous than the hosts. I guess not in our own world, right? So if you're listening on Spotify, you're listening on YouTube, give us a like. And remember, we are a live show, so you can join us. You can join us LinkedIn. We tape in front of a live audience. But again, if you're on our YouTube station or our Spotify, we are sponsored by Velix Valuations. They have the most experience, and the reason I like working with them in the hybrid, there's about 4 different appraisal results you can get. And because they're not an AMC, they're an appraisal firm, I'm able to make introductions to their CEO. And I think right now, as we go to the advocacy conference, appraisals is always the number one item that has been brought up the last 2 years, really since one of those reports was brought up. I forget the acronym, but I don't want to spend too much time on it. But it will be when you guys will hear me report live from advocacy. This will be my 9th out of my last 10 years going down there outside of COVID. And I'm excited for that conference. Also sponsored by Silverworks Solutions, which is a persona-based bot company that I work closely with. And if you're listening on, again, Spotify or YouTube podcast, we'll put that in the comments. Michael Zhao, can you give a quick shout out to the family offices we work with? And they're nice enough to work with us to allow you to come on every Thursday at 2.
Absolutely. Currently with ARC Family Office, providing bridge financing from a private family office. So underwriting is done privately. So there is no major matrix. It's makes sense underwriting, how it should be and how it used to be. So we appreciate that. Of course, ARC was at the MBA Commercial Real Estate Forum this week in San Diego. So we were also able to attend as well with a few meetings over there as well. It was great attendance.
Yeah, how was that? I saw there was a lot of people from the MBA that are on the origination side that showed up to represent the MBA. I saw, I think, I saw Bob Brokesmith. I saw Laura Escobar there.
Yes.
It was a good turnout, right?
Huge turnout. I mean, they were taking, every sponsor has their own private hotel meeting. Everyone that even wasn't a sponsor had their own hotel. This is not even a joke. I think there were 3 floors of just appointment rooms by various companies, whether wholesale or ancillary service. It was well attended, and there weren't as many sponsors in the trade show, but there were a lot of rooms with a lot of meetings, which was actually a really good sign. So I was really happy to see them at the Hyatt downtown San Diego. So it was really well attended. I had an opportunity to have several appointments and meetings done. Well attended, and I'm happy to see and say that the future of multifamily is looking very bright, and not only for renters but also for investors as well.
And how is multifamily the canary in the coal mine for housing? Is it on the inventory side? Is it a trend of where rates are going? Is it a trend? Are there any age demographic or race demographics that they're able to come out of there? Does it make sense for originators that are not in commercial to be there, like that are there today? Well, what could they get out of it?
Well, that's an opinion question, right? My opinion is that if the riches are in the niches, meaning if you do residential, stay in your lane. If you're doing commercial, stay in your lane. Very few people that have the capacity in their brain to do all of the above, right? The adage goes, chase after 2 rabbits and get none. So I think that if you're in the retail origination space, and you're like, hey, I want to do this multifamily deal because it's going to be an $8 million mortgage loan, and I'm used to doing $800,000 mortgage loans, and stay in your lane. you might not understand the software is different, the underwriting not too different on underwriting, but some of the language that you use is going to be different. I got 3 referrals from 3 retail originators this week, and I just realized for intelligent people that some of the verbiage is just different. So stay in your lane is my advice. So just like anything else, if you don't know what you're doing and you want to earn a full boat from it, you should probably, in my opinion, not do it.
I think that's great advice. And if you're again listening on our YouTube station or our Spotify, we actually last week had 2 views per hour every hour after launch, and that was really cool. And I'm more excited about it than ever because the lineup we have this week is special. And once someone listens to one, maybe they listen to more. So out of respect to their time, I want to go, get through them quickly and let them go on. And they have a lot of work to do here in the industry. So we don't want to keep them on here forever. But we try to we are the longest running weekly show in mortgage audio, period. We're also, probably video too. And we're also the only radio show format. And eventually it's going to hit where people know that they can come when we're taping it and raise their hand and come up and ask questions to our great guests. Yes, we will let you up because we're trying to be like almost sports talk radio. And so just like sports talk radio on the, Velix hotline, we have Greg Sher, who doesn't need an introduction, but what is happening on LinkedIn where he is able to get organic results that I think only people traditionally paid for. It's unheard of to get whatever was 300 comments and 600 likes, or 500 comments and 700 likes. And it came right off the back of the IMB conference where he went up there and he said, look, CEOs of IMBs, this is a platform where it would help if we speak more about what is going on in the industry because we're all in it together. Since then, there's been M&A, and I think you're seeing where the top lenders are consolidating. And you need IMBs for the health of this industry. I've said it forever. Easy mortgage apps wouldn't be what it was. There would be no innovation. And I find the more M&A, the less CEOs, so the less people are going to be able to get their voice out there. And so Greg's becomes louder and louder. So I invited him on. Greg, usually Michael and I just go through Housing Wire, National Mortgage Professional, National Mortgage News articles at this point before we get to our other guests. But maybe you could just take us around mortgage for 7-10 minutes, whatever you feel comfortable with, whatever you don't. I mean, usually you feel comfortable with everything. But on this show, anything you don't worry about it. We'd love to hear, or our listeners would love to hear. And I think this might be the show that really pops our listenership, not on the LinkedIn audio, but in our podcast world on Spotify and YouTube.
Yeah, thanks, Greg. If you could just unmic, we'd love to hear and listen. By the way, I mentioned on my LinkedIn post when I was advertising the show, they were talking about mergers and acquisitions at Western Secondary last year in Southern California. And so the fact that we're hearing about this news today is amazing. Or not today, but yesterday, how you put it on LinkedIn. Why don't you give us a rundown on the first big news on the merger and acquisition?
What an honor to be on this record-breaking podcast. Thank you very much for having me. I'd like to do a little housekeeping before we get started. Is that okay?
Absolutely. Go ahead.
I have a suggestion for another name for the show. It's 2 Michaels, right? You guys are the main hosts?
We are.
How about mic'd up? What do you think about that?
We'll definitely have to think about that. I love it.
We have a mic drop. If we go mic'd up, I think people from a SEO standpoint, which is really what we do focus on. So having you guys on here is great. There might be too many more talks, not enough mic drops. I mean, not enough mic'd up.
Well, all right, let's pivot then into someone I know in the industry who's extremely jealous that I'm on here right now. You guys know Brian View, who's the founder and CEO of FinLocker?
Of course.
Yeah, he was on last week.
I understand that, but he, just between us, he would like to be on a weekly basis. So now you know.
Got it.
Okay? So now you know. And Michael, it was great to meet you at the IMB conference in New Orleans. It was a pleasure meeting you there in the bar. Although I will say you were drinking a non-alcoholic beverage, so you are all business. With regard to the mergers and acquisitions and my place on LinkedIn, as the other Michael said, I think it's widely known there's a major void when it comes to voices at the C-suite level in our industry. And really what I'm trying to do is just talk about the things that are happening in the industry and get people's feedback and impressions and feelings about what's happening, because things are happening so rapidly. And obviously the amount of people that are finding themselves unemployed, that's really picked up at such a rapid, brutal clip. And I just want to make sure that they're not forgotten, that we're sensitive to how we talk about these things, and that we're all mindful of the fact that there are so many people suffering, and let's get them back to work just as quickly as possible. So that's kind of like the combination of my purpose and the genesis of around me being more outspoken.
Yeah, when we talk about New America Funding, Draper and Kramer Academy, and Guild, and the mergers, acquisitions, and of companies, it's just not a merger of multiple organizations. By the way, all those are separate transactions. I don't want to put them up in one, but it's also
Ian, Michael, for those listeners out there, the recent proprietary capital acquiring American Financial Resources, we have the person who was on the proprietary financial side that worked with, we'll give a shout out to Stratmore Group on the AFR side. Robert Pieklo will be on later in this show as a huge voice back in the clubhouse days. Very excited to have him on there. Continue with your question, Michael.
Yeah. And by the way, I want to add something. I don't know if you knew this, Greg, but the Mortgage Bankers Association has a program for membership. So if you are a member of the MBA, in other words, if you're an underwriter, or an originator, or support staff, and you are a member of the MBA, and you want to remain a member and your membership runs out, the Mortgage Bankers Association has a program called the Passport Program. And you can join it, and it's a reduced fee, and you can remain a member of the MBA just by making a phone call, as long as you're a member. So I would say for any underwriter that is currently employed, doesn't know what's going on, join the MBA so you can get a voice, number one, be a member of the Mortgage Action Alliance, which is the political action committee, and so you can have a voice within our own industry. And just so you know, the fee to rejoin if you were laid off and then your membership lapsed, if you are currently laid off and you want to be a member again, it's only $50, and you're going to be a Passport member, and it still gets you in touch with the emails and the contact and being in touch with the Mortgage Bankers Association. So those are for those who get laid off from those organizations. It's just good information. So Greg, why don't you talk about what's going on in the news today with those mergers and acquisitions? Tell our listeners, for those who don't keep up with you on LinkedIn right now, why don't you tell our listeners what happened with in mergers and acquisitions this week?
Oh my goodness, where do we begin? There's so much activity. I've counted from the beginning of the year, there have been upwards of 17 or 18 different transactions, and it's
we lost him there.
What is it?
To speak. While we're waiting for him, Robert, do you want to talk about your? Just tell us what's going on with you. I mean, everybody's talking about going from IMB to broker these days, and you've done the opposite. So, and I think every time you've been on a Clubhouse show, I talked about Robert and I did not just meet virtually. When he was with AFR as a C-level, I was able to get an intro at the beautiful secondary conference in New York, which has the Marriott Marquis, and I think you had 5 people with you, Robert. I was very intimidated, but you've always been, you and I don't know if Bill's still there, but you guys were always on ahead of the game on the wholesale channel, especially around government loans. What's going on? Tell us the news, and then what can loan officers learn about? What are they going to hear about this new brand out there?
Oh, well, thank you. I wasn't prepared. I'm not ready. I still have like 5 minutes before my time, but I'll step in and try and help you guys out here. Yeah, listen, this is, it's been a full circle moment for me personally, right? This is something, I grew up at AFR. It's something that, I started there 2003, worked through till just about 2018, and having an opportunity to work with the proprietary capital folks. And I want to clarify, there's a fund has purchased AFR. Proprietary capital is behind the fund, but this, technically speaking, proprietary capital is just the expertise behind the fund that has purchased AFR. And I'm very proud and really trying to think of the right words. But I'm just grateful for the opportunity for these guys to look to me, and I've been advising on the transaction. I was advising on the transaction for a while, to entrust me going back to what I would call home. And it's been a 5.5-year hiatus since I've been there. But we have a lot of good things in store, and AFR is an incredible company with incredible people, incredible expertise, especially in the wholesale space. They have a great little brand called Elend that is a little bit on the consumer direct or retail space, and really want to understand that in this moment in time, and kind of what Greg was going to be talking about. I know he's back. We can get to him in a second for sure, and kind of with this M&A and kind of where the market is and where margins are. It might sound crazy to want to buy a mortgage company, but this is the time. This is the time to do so, and we see incredible opportunity. And for the first time in quite some time, seeing some cracks in the foundation in some of the channels and with some of the bigger players that are out there, where it's just tough to grow all the time, especially when you get to a certain size. So we see incredible opportunity in the wholesale channel and the correspondent channels. We think that this is one of the best times to be involved in a transaction, and you see it with these companies that are out there right now. It's just the market's tough. It's just a difficult market, and this is the time you kind of have to go in running when everybody else is running out, and that's where we're excited to get going. I'll pause there because I know Greg's back. If you want to get back to Greg.
Yeah, I'm here, and I'm not sure why we had
ask you. Oh, sorry, I was going to ask you, Robert, when we segue back to you, just a question about your knowledge of margins and looking at P&Ls. I just, what goes into now is the time. But Greg, I know you were going to go around and talk about M&A, and I don't know how comfortable you are, so I'll give you another avenue if you want to. You had the most viral post I've ever seen on LinkedIn, and I've been on it, advocating for it since 2013. Maybe if somebody's posting a job because it's made for jobs, they get, but outside of jobs, never seen anything like it. And you said something so simple. You didn't use ChatGPT and come up with this big, profound, AI is going to, you just said simply, in the vendor world, people like relationships, and be careful of who you hire and fire vendor owners, whether you're from Silicon Valley or, you grew up in this industry. There are relationships, and we care about them here in mortgage. And then everybody gave their opinion. I've never seen anything like it. It was all organic. No one was just saying thumbs up, happy birthday. These were paragraphs in your comments, like 200 of them. Should be a case study on this. Can you just talk about what I want to know is, can you talk about what it was like that day? Like, one comment, two, you were reading them, then you're like, I got to get back to this. You went into a meeting, you came out. I think that's what we want to hear, because anybody can relate to that, whether they're in mortgage or not. What was it like being LinkedIn viral in a world that really isn't TikTok? It's hard to do.
I was surprised. You never know when you're going to post what kind of traction it's going to get. I don't do it necessarily for the virality of things, but I think it kind of underscores that I'm trying to talk about the things that are prevalent and present in our business that other people are just reluctant to talk about. In this instance, what I discussed is just my frustration dealing with our CRM vendor, and this had been mounting and bubbling for many, many years, as I detailed in the post. And something happened that was just so far out to me, that was just the last straw, and I just had to scream from the mountaintop about the experience that I had had, and ask the question, what's your experience with CRMs, and who do you like and who do you use? And before I knew it, I think I maybe had 20,000 impressions in the first 12 hours. It was wild. I did not imagine that it would be like that, but it's really not about my post when I look at it from afar now, and more about where you can take a topic that people in this business are passionate about. And that's what really impressed me about the strength and power of the message, and the willingness for people to step up and talk about it. I was really, really shocked. I mean, the post to date has 37,000 impressions, 262 reactions, 258 comments, and 10 reposts. And so what that says to me is, no, not great job, Greg. Oh my goodness, you made a viral post. It says to me, look what happens when the floodgates open and people have a forum to be able to express how they're feeling about things related to this business. And that's really the backdrop from which I work when I try and post things. That's it. It's very simple, as you said, yet kind of profound, it appears, when you factor in the engagement from people in the industry.
That's amazing, Greg, because not only do you have the 37,000 impressions, but you have to think of who are the people that copied your post via screenshot, sent a text, and got it multiplied as a result of a share, not just via the LinkedIn post, but also they sent it via email, they copy and pasted it, they emailed it out. So I'm not sure, but I'd be confident to say that's an incredible feat of newsworthiness that you sent out, only because of the multiplication level of how it gets out there. And the fact that it gets out there with what you did means that more people want to know, more people want to be informed. And although we can trust our news sources like National Mortgage News, Housing Wire, and the other sources, it's awesome that we can get people that are on the street, not just that are reporters, but people in the business that understand what it takes in order to make things happen.
Amazing. Well, I appreciate that. Isn't it though, when you consider how many people reacted to a little post about a CRM, and then you look at some of the other posts that gain traction, just how starving our industry is for a place to go and speak. I mean, that to me is where the opportunity is. And I've had some conversations with some people I trust and respect a lot in the business about a lack of a voice for many people in the IMB space. Obviously, the Mortgage Bankers Association is amazing, but they represent companies and they work directly with CEOs. But what about the loan officers? What about the processors? What about the closers? What about the funders? What about all these other people that make these businesses go? Where can they go to have their voices heard? It's kind of that thing like the fans in the stands pay the salaries of all the athletes. That's who these people are, right? And I think that they're underserved and their voices are underheard. That's a word I've just made up. And so I think there is room.
There is a lack of collaboration, and the mortgage industry hopefully will, I think is in a little bit of trouble because, you have a lot of IMBs that I think are, you can hear it on our show. I talk about innovation wouldn't happen without them. Advocacy, when you look across the advocacy conference, it's mostly the IMBs that are powering. But they just went through $700 billion of, tech funding for a point-of-sale market that is making the consumer fill out 265 questions. We're still checking the checker and calling, and so that opportunity probably could have been better if there was a better collaboration that wasn't charging people to be part of. And then, people sent their closers, sent their processors, sent their loan officers without fear of, losing them. And so to leave you on these words here, Greg, in times of certainty, you can't provide, in times of uncertainty, you can't provide certainty, but you can provide clarity. So they say in times of disruption, like we're going through, if you're a loan officer, closer, reading these headlines, for a leader who's typically fact-driven, strategy-driven, they answer questions better than anybody and have answers and right answers. But in this time, they say a voice, and I've been listening to some podcasts on this because we are going to have a leadership spin-off show. Would love any of you three to be on it on season 1. But voice is more important than words. Presence is more important than presentation. And clarity is the next best thing to certainty. What do you feel IMB leaders, they can't miss that right now their loan officers, closers, processors are reading these headlines? How do you think, what would your advice be to have a call and get your own workers involved and provide some of that clarity? Any advice for the industry right now, like to tell them how scared some people might be?
I think it's company by company. I think so many CEOs are amazing at being there for their people. I'd say the vast majority. That's not exactly my point. I think my larger point is outside of your organization. If you're a link in the mortgage manufacturing chain, loan officers, LOAs, processors, whatever, they rely on their company to be their voice for advocacy, right? So, and then with so many CEOs if I asked you guys who the 5 most vocal CEOs at the bigger companies are, not even the bigger companies, let's call it 3 billion or more, who would you say those people are? I'm asking you right now. Well, let me put you on the spot. Who are the top 5 IMB voices? Who are the leaders in our industry who have the market share?
I've been thinking about it since you posted. To say that what needs to be said, the only ones that really come to mind are Steve Milner from U.S. Mortgage Corp out of New York.
Yep.
And then
You'll hear a lot. You'll hear a lot of dead air. So
you just got it from me. I don't really have any.
And if anybody why doesn't someone pull up the top 10 mortgage lenders? Who do you hear from? I mean, I'm not going to name names. I'm not going to do it because I'm just not. But you go ahead and name the names. I mean, you know who they are. Who's the lead? Why are there so many CEOs? The only time I hear from CEOs at the bigger companies is when they're talking about their accomplishments or how they broke ground on a new building. Why hasn't anybody in the industry, any of these high profile players, screamed from the mountaintop? It can only help show that they care about the industry. I don't know. I just feel like it's a big miss. And
it is. And then
it is.
Where you need
I agree.
To do it. And even when I think I talk to more CEOs than anybody in mortgage, it's what I have to do. And I go toe to toe with anybody on that. And I find some of them don't even control their own account, but pretend they do. And I've been talking to an assistant or a bot as them, which is not, so I think now is the time you need to reach back in. You don't need to be on TikTok or Instagram, anything. Just get back on LinkedIn, talk to your community. Thank you, Greg, for coming on at the halfway mark. If you're listening on Spotify and YouTube, please like and subscribe. And I should say we're the only live show. The Licking on Lending, great show. Now that I think about it, has been live.
Yes.
We and you can call in there, but we actually give you the way, go on LinkedIn Audio Thursdays at 2. We have an audience. Sometimes it's bigger if I have time to invite people. Sometimes it's smaller. But like what Greg's saying, you come on and ask questions to our guests. You can ask questions for me to put me on the spot to go find you answers. We want to be more interactive than anybody. And as Greg said, the bar is very, very, very low. So thank you, Greg. Let's segue quickly over to Rob Pieklo. I said I had a question for you. We're going through having a boutique hotel come into our local town. A lot of selectmen meetings on it because we're giving up a waterfront school to do it. And there was other. And so what I found interesting is they went through the P&L and they were able to find through amount of beverage projection sales, which boutique hotels probably were going to make their money off of rooms versus how many were going to make their money off of bringing in huge weddings and, people coming into our town. I just found that fascinating that you can go into a P&L and look at a balance sheet and look at things differently. I don't know if you had a chance, Robert, to look at other companies or if it was AFR from the beginning, but what's it like as somebody, that kind of has a good gut instinct of where margins are going and everything? What's it like shopping out there and what can you learn from people be looking at from the financial standpoint moving forward in mortgage?
Mortgage business is tough, and it was really tough in 2023. That's what I learned. It's it's an interesting business. We got to take a look at certainly some targets while going through the process. There's always opportunity, right? And someone else is standing outside and looking into your business. If you're running your own business, someone else looks in. That's why consulting companies make so much money, right? There's always opportunity and things that can be suggested, and what would be deemed low-hanging fruit for somebody looking in freshly at something. You can certainly see there's these opportunities in little pockets, things. You can always find those things when you're looking fresh versus being in the middle of the business and working and having that business provide you more of a reactionary environment than being proactive. So when you're taking a look from the outside, you see opportunity. There's certainly opportunity in a lot of companies. There's certainly opportunity, especially when you talk about like the resources and kind of your overall flat expense of a mortgage company. We know that that's significant. You do need to scale to make things work. We found a lot of good things going on at AFR, really good programs, really good margin programs, and just really things that people need that could be a good baseline as you look to grow like standard production in a space that is not deemed full of margin. We know the wholesale space and what's occurred to it over the last few years with the competition that's out there. But we're seeing it, and we're seeing an opportunity right now in the market. This is very similar. I was lucky enough in 2008 when everybody was running for the exits to purchase into AFR. And it was in the middle of a housing crisis and nobody wanted to touch a mortgage, and it was a good time to get in. I would equate this time to be very similar in a market condition of that. It's probably a little less, a little less panic over, overall global issues. But in terms of the business itself, it's in obviously a significant low point. And I think the last couple of rate moves and projections and predictions that that people were kind of holding on to, having those things not come to fruition. We had a couple dates last year that were kind of called out by the gurus, and those didn't come to play. And we've had some really smart people be wrong on where rates were going, and here we are, staring at a 10-year in the 430s, staring at rates in the high 6s, low 7s. Certainly not a lot of people anticipated that. So we're going through another little wave, and you'll see it. It's going to get a little bit painful. The last couple months going to be painful. We'll see what the spring buying season comes into. But with rates where they are right now, it hasn't been expected. People have been waiting for that tick down. Now that that's not occurring, and we may be sitting a little bit higher for a little bit longer, it's going to be interesting to see what plays out in the M&A world.
Rob, it's incredible that you've been able to navigate this. That there's that saying, buy when there's blood in the streets and sell when the people are dancing. And right now, there's blood in the streets with the M&A, in at least in the current environment, not just with the independent mortgage banker, and also probably in general FDIC banking as well, as we've seen this past year and a half or so. When it comes to when you were taking on that advisory position for yourself, what are you looking at? Because if past performance doesn't dictate future results, what are you looking at as far as the financials are concerned, or how a company is not only going to perform for you, but how is secondary going to, how are you going to be able to run that secondary position so that it's an efficient company? I was just reading the book Demystifying Mandatory that was put up by Jennifer Fortier, and she was writing that, you don't necessarily want to create it as an opportunity P&L portion of the mortgage company. It is going to come at times, of course, but you don't necessarily, you're just trying to make the pricing as sharp as possible. So if the case is you just want to make pricing as sharp as possible for the originators, then looking forward right now, as you're completing that M&A, what are some of the things that you're looking at from a high level view to create the best financial model? What are some of the numbers that you're looking at, and some of the future profitability items that you may be looking at? If you could just nail off some accounting terms, maybe instead of going deep into the weeds of the numbers themselves, maybe some accounting terms of what you're looking at, how you manage to put that through so you could actually complete a merger. Because we've seen a lot of that in the last, and we're going to see more of that in months to come. But for our listeners that are out there, so they can get an idea of what someone might be looking at, could you give me a short level view of what you were doing accounting wise, or from capital markets, of how that might be defined?
Yeah. So, good point. There's a lot to unpack there, but I'll go with the simple portion of this, and that's simply looking at like where execution is thought to be, where the market is thought to be. I think that's really important. So when you see where somebody is executing, and that there's opportunity in whether it's spec, where you have these different characteristics of loan that get more pricing and more premium, how things are being sliced, how they're aggregated. If you look at like high balances treated differently, you look at some of these lower loan balance loans are treated differently. So you have to see where things are being marked, what they're being executed at. And then right away, you can see like, wow, we're not, they're not taking advantage of certain stories. And that's where you have to start. And secondly, you have to like when you're looking at an overall picture of a company and their dynamics and how efficient they are, you have to like throw out 2020 and 2021, right? You want to more likely look at like what the tail end of 22 was, what was 2019 like. You want to look at things like that, because it was really easy to think you were very smart and good in this business in 2020 and 2021. That goes across the entire spectrum. A lot of people made a lot of money. A lot of people didn't do things properly. Didn't matter. They made enough. Who cares? They threw human capital at it. It was fine. But in terms of this, you have to look at the way the businesses were run then, and are there tweaks and things that you would do when a margin environment doesn't allow for 300 or 400 basis points of net margin? When that isn't there, how do you handle that? So, that's what we looked at. And then, like I said, execution is everything. And the last thing I'll say in the simplest of terms is, a lot of companies, a lot of secondary guys, a lot of capital markets and CEOs, they kind of go back and forth, or sales and capital markets, to price not to lose money. And it sounds weird, but you like, oh wow, there might be a hit if if I have a high balance loan that goes into a certain type of pool, and it could be a huge hit, or it can go into a standard pool and we can make more money on it. We don't want to take that hit, so they'll price to not lose money. Where I think taking a different approach, and what a lot of capital markets and secondary teams do, is they take the loans that they have and find the best execution for them. I think we have to take and flip it around and say, where is the execution? Where is it that there's a desire for a certain type of loan? And let me go out and price as aggressive as I can on that segment so I can get those in and not worry about getting some gains on execution after I already have them, because a lot of times you can't get them. You didn't price them right. So there's a lot of that right now, being proactive and putting out, certain note rates are getting way more attention now. Certain coupons are pricing better. Certain servicing rights are worth more. These are all the things you have to pay attention to and price out versus trying to do a easy, lazy secondary type action and putting out a price that's easy to do with blends. You just don't get the right type of production that you want. So that's how we looked at it. That's how we handled that portion of it. That was a long-winded, short answer, Michael, but I hope that answers there. And then from the team members that that we're working with on the proprietary capitals fund that they created for this purchase, we have some of the best. And I deem myself somewhat of an expert in that space. And I have learned more in the last couple of weeks than I have over the last 4 or 5 years. These guys are incredible, and we have some of the best in the business that are guiding us and giving us ways to gain on execution, whether it be 50 basis points with this product or 100 basis points to kind of bypass the GSEs and go to a PLS product. There's a lot of that happening right now, and it's pretty amazing to work with these folks.
And we have Dan Sogorka on after, who really has transformed servicing from a consumer standpoint, whether it was with his own company or like the old WWF, WCW days. He brought some competition to the market and to where he used to run, Black Knight. So with that said, what would be 1, 2, or 3 takeaways, Robert, that loan officers should be thinking about servicing different now than they did 10 years ago? Or you can take that question wherever you want. 1, 2, 3 things loan officers should be taking away different than maybe they did 10 years ago from home ownership standpoint.
Yeah, I mean, I think for loan originators, just in general, of how things are done and how to work with I can kind of talk about what we're looking to do and expanding home ownership and making sure that we're bringing the opportunity of home ownership to more people. And that's kind of a big thing that we have to be looking for, and doing that by putting new products out, better pricing out, better opportunities for rebate to help cover costs. Like, these are the things that loan officers could be looking to companies like ours to explore and expand on. I know that we have a lot of, big juggernauts that are out there in the business, but really, it's not always about, and everyone loves speed, and we're going to certainly work on speed. We'll be working on that as well. But it's about the product lineup, how we can help more borrowers. And if there's a 45-day escrow, like we can find a way to get things done and give everything back to the consumer as best we possibly can to provide an incredible product. So loan officers just have to go out and look and find companies and find places to go that kind of meet the needs of their business. In the broker channel, you're going out to a multitude of lenders. You got to find some that are willing to work with you and have that relationship to provide the products and programs along with a good price. Obviously, the price is important, but really, maximizing they can their product lineup out there for their borrowers. And AFR and the team and what we're building right now, it's going to be this. It's a step approach. It can't happen overnight. There's a lot of things to work on, but I'm excited to kind of invite, specifically the wholesale and correspondent channels in to kind of see our commitment to that channel and see what kind of partnership AFR can create with their companies. If there's loan officers that want to learn a little bit more about that and work with that, talk to your, secondary folks at your companies, the people that handle the lending relationships, and reach out directly. And we're very, very excited about what the future holds and what we're going to be able to offer those origination channels when it comes to products and programs and helping more homeowners.
Thank you. And everybody needs to have AFR now on their map. And Robert Pieklo is the pioneer in audio and really got us here from the Clubhouse days. And if you don't know, you don't know. It's kind of my take. So thank you, Robert, for coming on. We are going to invite you on in the future. And we're going to move over to Dan Sogorka, who I think, as an entrepreneur in this space that now deals with larger companies that Dan runs. So Dan, you've been on really on both sides. You were able to make a living in this industry at the highest levels because you came up with an idea out of nothing and kind of brought it into existence. Can you tell, because our audience is loan officers and realtors and executives more come on our LinkedIn, can you just kind of tell the story about how an idea in mortgage can turn into something more?
Yeah, sure. And thanks for having me on, guys. I appreciate it. Looking forward to this. Yeah, it's funny talking about some of these older times. I started in mortgage technology in 1999, essentially late 99, early 2000. And, so over the last 20, 24, 25 years, you've seen these cycles play out. It's interesting how this, the independence and the banks, and you have kind of that thread, and then you have this boom and bust in terms of the companies that make money and the people that are really successful, and then you have the correlated spend on technology at these different points in time, and it's almost, when I look back, it's almost like a race to find the sweet spot of when people have money to spend and they have time to focus on their tech stack. You have to kind of do as much as possible in that time, because you lose the window, right? So to answer your question, you have to have a great idea. You have to have great support. You have to get the right customers at the right time. And then you have to build from there, right? So it's like you get this crack, you have to get in. Obviously, you have to have the right team as well, right? So a lot of things have to come together for mortgage technology vendors to actually have sustained success. And it's not going to last forever. So you also have to be smart around looking around the corner. So some of the companies I've been lucky enough to be affiliated with, and we had great teams, and we were able to kind of ride the wave of some of these boom cycles, and then have enough, I would say, momentum and enough of a broad set of customers that we didn't get destroyed in some of these downturns, right? Like I like telling the story about of my customers in 2007 and 2008. A lot of them were the top non-banks in the space. None of them exist anymore. These are the forgotten names of AmeriQuest and New Century and Option One. I mean, a lot of the people are still around in other gigs, but those companies are gone. And so, we were lucky enough to ride that wave at that point in time of really kind of the leading non-banks, and typically what was called back then subprime lenders, and then get into the banking space before the market fell apart. So in 2010, 2011, 2012, my customers, then my largest customers were JP Morgan and Wells Fargo. But at the beginning, it was, AmeriQuest and Washington Mutual, right? So you really, so much of it, it's like what everybody says, it's hard work and a lot of luck,
Dan, in your experience as a servicing company, a lot of people really don't, as an originator, that is, they may not understand how profitability is for a servicing company. But were those times between 2008, 2012, for everybody else that was an originator or kind of going through a tough time, and anybody that was going through a tough time then, and even more so the last year and a half, was it more profitable between 2008 to 2014 because of the losses? And because in servicing, a lot of people don't understand how a servicing company actually makes money. But if there's like late fees or so on and so forth, and you guys are taking, I won't say it, if you guys are earning, I'll put it to you that way, if you guys are earning a little bit more of the piece of the pie when it comes to late fees or penalties or things like that, was it more profitable during that time period? And how does it compare to the last year and a half where there weren't any foreclosures and maybe not so many late fees, and maybe a few modifications because of the last year and a half? But I mean, how does 2008 to 14 compare to like 2022 and 23?
So good question, and I gotta provide some clarity, and then I'll try to answer as best I can and give you my perspective. So until I took this job with Sagen in March 7th of 2020, I had mostly worked on the origination side of the business. Most of the technology that I dealt with, even when I worked at Black Knight, I was running origination technologies. So my career up until 2020 had a lot of exposure to the origination side. So I, in another kind of stroke of luck, right, when this particular market turned, Sagen is entirely a servicing focused company, right? Servicing software, and our customers actually have done really well in this cycle. So while the macro for kind of mortgage overall has this very dark overhang, mostly because of all the origination struggles, from a servicing perspective, it's been a great time to be a servicer. And our customers at Sagen, Mr. Cooper, Freedom, Carrington, these guys are really winning in this environment and have been winning, and I think are going to be set up for success going forward when the market turns. But to your question, servicing is very different now than it was back then in 2008 to 2012. And I don't think we'll ever see anything like that again. Because I think, government forces, no one wants to go through that in housing again. And the ways a lot of those companies made money was managing everybody through this, that vicious default and foreclosure cycle, right? But what you see now in this cycle, that is not happening again. So there's essentially no revenue from foreclosure and default at this point in time. Very, very low, lower than kind of the base level even before COVID. So what I'm seeing now with the large servicers is more. It's more of an investment strategy and almost asset management, right? And really think about it as a building up of a future pool of customers that they'll refinance when rates come back down low, right? So if you go and you listen to the earnings calls of, Jay Bray at Cooper, Freedom's not public, but Stan talks at a lot of conferences, and you can hear, his perspective on this. They're really looking at servicing as an asset, and they're really building up huge books that they plan to refinance very profitably. So I think in, 25, 26, 27, people that have a large servicing books are going to be the winners in the space. Whereas, back in, oh, sorry, go ahead.
No, continue your thought.
I was just going to say, 2008, 2009, 2010, literally servicers were, I love this one story, like you're renting out empty shopping malls and filling them with people to send out loan modification packages in the mail, right? Like hundreds and hundreds of people hired to just do all that kind of work. And today, what we tried to do at Sagent is to prepare for an event like that to happen again so that everything would be automated and self-serve, right? And Michael, like you said earlier, it's like so hard for this industry to get there. And because it's just like so addicted to paper and double checking. But, we made a lot of strides in my 4 years at Sagent. And I think, obviously, they'll continue to, such that you don't have to do the silly things in terms of paper and filling out documents, especially if you're a homeowner going through a tough time.
There's a lot of opportunity because of tech in servicing for people that are falling behind. Excited about that. And I could tell a million stories based on what you're saying, but everybody's here to hear you. I want to get back to, I always try to, when I tell the Easy Mortgage app story, go on the importance of how much you have to get out of your comfort zone to really get involved and be welcomed into this industry. In your first couple, and I think your first business was really cute, right? And so like you eventually were selling to Chase and other companies. For loan officers, real estate, anybody that has an idea out there and wants to get into mortgage, and they typically want to get into mortgage because mortgage pays W-2, so it's easier to sell your product at an enterprise level. What was your journey into mortgage, and at what point did you feel comfortable going to events and feeling like you could go up to people? Like what's that journey for an entrepreneur in this space?
Yeah, so my first company was actually escrow.com, which was a Fidelity national financial company. And this is when Bill Foley and F&F were kind of rolling up and becoming, kind of as big as First American. And the F&F team was a big believer in technology to make things more efficient. So I went from escrow.com to Real EC. You were close with the Real EQ, just one letter off. And, the original kernel of that idea was to connect title companies to lenders to automate the ordering of title, which it was still done by phone, right? So I literally had a little cube up in an office in Santa Ana. I had a piece of paper, thumbtacked into the side of my cube with the top 50 lenders. And, I was assigned 15 of them. The two guys, on either side of me were given the other 15. And it was literally go try to get in there. So you would like call Bank of America and get the operator and ask for somebody, related to title insurance. It was pretty comical. But that was the start, and so it's just like any other business. You make a million calls, you get a ton of no's, and then you find somebody that connects you with somebody else, and you get your first deal, and then you go and try to get your second deal, right? I remember the first day I had sold appraisal ordering once we moved from title to appraisal to AmeriQuest. And the first day we turned them on, we got 3,000 appraisal orders, which was like, literally they doubled the size of our business, and we just couldn't believe it. And we sat there watching the screen as all these orders came in. So, we really grew that business by, and this is a repeatable playbook, right? You do one product and you do it really well, then you expand it to an adjacent product and you do it really well, and you build that up. And we built up what became a huge, what I call dual-sided network, where you have, the lenders on one side and then all the service providers on the other. And another way to think of that analogy is, you have a highway, and once the highway is built, now you start selling hamburgers, then you start selling sodas. Let's put a gas station up there, right? Everybody's on that. And as long as you do a good job, and you treat people well and you value your relationships, you can keep building that. Because to the point made earlier, people want to work with people they have relationships with. People want to work with people they trust, especially in this industry. And you just have to put the time in, and, you go to the shows, and at the first one, you don't know anybody. At the second one, you know 2 people. Now you walk around and it's like going to a high school reunion, right? So, I love bringing young people into this industry and just basically coaching them the same way and making introductions for them, kind of making it easier than it was for those of us who kind of started from scratch.
If you have a loan officer that, he has a nephew, a brother-in-law that can code, or a coder, right? So they're able to come up with this awesome interface solution. Would you recommend today, moving forward, knowing where the industry is going, should they go out and raise VC? Should they try and get a large company, like a Bank of America, Goldman Sachs, Chase, to use it in mortgage? Or does that end up becoming, obviously we know the cons to that. You become working for them. Or do they go friends and family? Or do they maybe, like, I find it fascinating, there's very little avenues through the collaboratives or mortgage banker to really kind of keep them from going down those avenues. So any recommendations on where somebody should go, or maybe it's easy to say the one direction they shouldn't go?
It is a tough time to raise money right now, right? And if you're raising money and at the VC level, at a minimum, you're not going to get a great deal or a great valuation. I think, if you have a great idea and you're into tech right now and you're a young kid, I have 2 boys that are 18 and 16, and, I'm sending them stuff about AI all the time. I'm like, this is what the future, your future is going to look like. So, read up on this now. I think you have to bootstrap, to answer your question directly. I think it's a great time to bootstrap. I think it's a great time to, not raise a bunch of money, and come up with something that's net new and incremental, and then get in front of these entrepreneurs who run these businesses. To the point earlier, this space is so entrepreneurial, especially on the independent mortgage bank, that and a lot of these guys like to invest in the companies that they work with. So have a great idea, bootstrap it, and then go and get it in front of the guys who own these mortgage companies, and show them how you can change their economics.
Appreciate you coming on. Before we go, we'll put your information in the comment section. For those listening on our YouTube podcast, please subscribe. Not only for this podcast, but our mic drops are going viral, or at least within mortgage. And if you're on Spotify, please subscribe as well. That's what's able to get us better guests and better sponsors, so that we can treat our guests even better. With that said, Dan, I don't want to leave without you telling us what your next chapter is, and it might just be relaxed. But for listeners, say your information on there is your LinkedIn account. Who could reach out to you? What are you still open to right now? And if not your next chapter, what are you going to be looking for as you watch others?
Yeah. So I don't have a next chapter planned yet. I'm having a lot of great conversations. I think it's a really exciting time in the industry. I think the companies that are able to invest over the next 12 to 24 months are going to have a massive windfall on the other side of this cycle. And I think that the companies that can get really efficient and really automated are going to be huge winners in the space. So I'm excited to watch how it all goes. I'm excited for Sagent to keep pushing forward. I'm excited to see if we can finally, get to a platform, an ecosystem as a mortgage industry that is all connected and all digital and transparent. And I think there's an opportunity to do that. So I'll be looking at things that kind of, focus on that.
Daniel, totally grateful that you were able to come on. I would love to invite you back onto the show, because one of these days I want to, on the air, talk about what goes on into your head when you're at the beginning of a phase and the middle of a phase and toward the end of a phase of the development of an ancillary service for a mortgage service provider. Because I think that leaders want to know how your brain works, and leaders want to know how your math side works, so that their financials would work as well. And then how does the leadership work in the future? So for those of our listeners who are listening, I'm looking forward to hopefully getting Dan back onto our show to talk about the leadership of an organization, to lead it to success, and then to how to successfully exit, as you have been able to be leading into that for yourself. And I think that I would love to talk about that more in detail on the air.
We'll have our listeners, if you listen and comment, bring back Dan in the comment section. If we get enough, we'll present it to him. Thank you, everybody, for listening today. You're getting a bunch of claps there in the audience, and we do love having this star-studded podcast. We hope everybody listens and everybody shares it with people in the industry. Thank you again.
All right, guys. Thanks a lot. Take care.
Thank you.